Howdy, Jacob here. Today we're looking at the Ensign Group in the healthcare providers and services industry. 8.5 billion market cap on 8.1 billion enterprise value. They provide skilled nursing, senior living, and rehabilitation services. I'm trying to see if it says it operates in Arizona, California. Okay, so it does operate nationally. Company was incorporated in 1999 out of San Juan, California. Growth in revenue has been out of this world. You're looking at double-digit revenue growth over the last 10 years, 1 year of revenue growth decline outside of that, just massive growth. Gross margin is not super grand, but 15 to 20%. It's up from where it was. Operating margin up from where it was on an average basis. It got up to almost 10%. Now it's back down to the 6.8%, which isn't fantastic. Just like their return on invested capital, nothing really grand there, but that growth. So they're still reinvesting back in themselves clearly to have massive growth, and so that's going to dampen. It's going to likely dampen their return on invested capital and their operating margin. So they don't see any. We don't see any research and development. So majority of their cost of goods sold, or majority of their expenses, is just the materials to sell the product. Their cash and cash equivalent is 510 million, short-term debt of 4 million, long-term debt of 145 million. So majority of their debt is going to be their capital leases. And I guess that would make sense to me given the fact that they said they are a healthcare provider and services industry in the nursing, senior rehabilitation services. They likely own a lot of nursing homes, senior living homes, rehab service homes, and that's going to be a lot of their capital leases. But if you look at their long-term debt plus short-term debt, they have more cash on hand than both of those combined, which is a very positive sign for a balance sheet, especially for a growing company. And we see that their free cash flow is very solid. They've produced a lot more cash from operations than capital expenditures, but their capital expenditures are growing. So that's also showing the fact that they're really reinvesting back in the business, and that's going to be seen with their property plant almost double what it was, or over double what it was 10 years ago. And use of free cash flow, pretty heavy on the acquisition side. They are reinvesting through buying other companies, hopefully making themselves more efficient. Recently, we saw maybe some efficiency, but really just hitting the top line and bottom line equally. That's fine for a company that's really trying to just grow at this point. But later, when they do become a more mature company, we do want to see them become more efficient with those acquisitions and not just hit the top line. So share repurchases is another dividend that pays out 1.9%. Wow. But in relation to their free cash flow, it's nothing. So they can still absolutely afford that dividend. Okay, this could be interesting. So let's go to make some assumptions. I'm going to say on the revenue growth side, they've been growing a lot. They've been spending a lot of money on acquisitions, but the good news is they're not spending more money than their free cash flow allocates, at least in the last 7 years or so. And so it's not like they make $100 million and then every couple of years they spend $400 million on an acquisition and go into debt to do so or issue shares to do so. They only did that in 2015. Outside of that, they've been very solid about not going over their means and capabilities with acquisitions. And so I think, especially with a lot more free cash flow coming in, I'm definitely going to be safe assuming 100% capital allocation through free cash flow going towards buying back shares, making acquisitions, and then paying this dividend. And so this revenue growth with acquisitions being maybe 20% or so of capital allocation, I feel like they're able to grow pretty heavily still. They're still not a fantastically huge company. And I think that as the world gets older, or as especially the US gets older, there's just going to be, there's probably going to be competition here, but there's also going to be need for more facilities like this. And so, I mean, maybe 10%, that seems reasonable-ish. Return on invested capital hasn't been fantastic, but I still think with the amount of growth that they have ahead of them, 18 to me at the end of 7 years seems pretty reasonable. With terminal or with margins of, I mean, they've gotten more efficient from 2020 to 2022, and then it's back down to almost what it was in 2014, 2015. And so this is going to be your subjective, research at this point just on the numbers. I think that maybe 6 and 7% seems reasonable. Share change, 1% for them is about 84, 85 million. And I mean, let's just say it's relatively flat. Let's say they just offset their stock-based compensation, shares issuance, and the dividend. We can increase that. We can increase that by 5% since they've done that in the past, because it looks like they're still trying to reinvest for growth. So they don't want to increase that dividend too much. But in all honesty, I mean, falling 61% before you get the return we're looking for here, I do think this is a good company. The growth could be very helpful if you are really an expert in this business and you're able to, have those 3D glasses looking into the future, and you're extraordinarily confident it's going to grow double digit for a decade or even 2 decades. This could easily be a company's where a 37 current P does not look crazy expensive. But again, based on the numbers and my initial lack of knowledge about this business, without doing more research, I like companies to be extraordinarily obvious. And right now, it just doesn't seem that obvious to me. But a great company and one that I want to own just at the right price. Hope you enjoy the video. Have a great rest of your day.